Welcome to The Debate. Today we're dissecting a really critical and frankly somewhat alarming piece of market analysis. It's coming out of the Neuberger Berman Private Markets Academy, led by Doug Maynor. And we're looking at the private equity industry at what feels like a definitive crossroads. I mean, you have an environment defined by higher interest rates, stalled exits, and a fundraising environment that's become undeniably hostile. So the central question we're wrestling with today is this. Is the traditional financial engineering model of private equity dead?
It is a provocative question, certainly, but I'd argue that reports of the industry's death are, as they always are, greatly exaggerated. What we're seeing is an evolution, maybe a painful one, sure, but it's not an extinction event.
We'll see about that. My position is that we are witnessing a structural paradigm shift, not just, a bump in the road. The era of easy money where you could buy a company, slap some cheap debt on it, and just wait for the market to rise, that's over. I think the data in this report shows that future returns now depend entirely on skill-based levers. And I mean intense operational intervention, specifically leveraging disruptive tech like AI just to survive. Market-based levers, they aren't just neutral right now. They're actively destroying value.
And I'm coming at this from a different angle. I believe what we're seeing is more of a cyclical thaw, not some structural apocalypse. The core advantages of private equity, patient capital, information asymmetry, those remain the primary drivers of value. The tactics are evolving, of course, but the fundamental model of buying a good business and waiting out the cycle, that remains intact. The industry isn't breaking. It's just reverting to the mean after a period of, well, a lot of excess.
Let's look at the reality of the situation, though. If you look at the capital invested, it paints a bleak picture for the old way of doing things. In 2023, capital invested was down 40% from the highs of 2021. That is a massive contraction. And it's not just a blip. We're seeing what the material explicitly calls a circular problem, where the entire flywheel has jammed.
Circular is a specific term there. Maybe explain what you mean by that, because it sounds technical, but it's really about behavior.
It is. It's the mechanism of the liquidity trap. Fundraising has stalled because exits have stalled. Private equity is a cash-in, cash-out business. The investors, the LPs, they expect cash back to fund new commitments. But right now, firms can't sell their companies, and if they can't sell, they can't return cash to the LPs. If they can't return cash, well, the LPs aren't giving them new money to go buy new things. The pump is just dry.
I see the contraction, certainly.
But look at the distribution rates. This is the heartbeat of the industry. Historically, you expect distributions, the cash back to investors, to be in the 20 to 40% range of net asset value annually. Right now, we have plummeted to historical lows of 10 to 15%. This is a liquidity drought. With interest rates crushing free cash flow, the old financial engineering math just doesn't work. The only path forward is radical operational improvement. And by radical, I mean navigating the disruption that Doug Maynor specifically flagged, artificial intelligence. You either use these tools to survive or you get wiped out.
I'm sorry, I just don't buy that this is a catastrophe requiring a total reinvention of the wheel. And let me tell you why. You cite the drop in capital invested, but you have to look at the baseline. 2020 and 2021, that was an anomaly. It was a sugar high fueled by zero interest rates and stimulus. Investment basically doubled. What we're seeing now, with deal counts down 20–25%, is simply a return to pre-COVID levels. It feels painful because we were all spoiled, but it's actually a normalization.
A normalization? We're sitting on interest rates that haven't been this high in 15 years. That changes the physics of every single deal. You can't call that normal based on the last decade.
Key to my argument. Despite all this chaos, rates, geopolitics, banking instability, purchase price multiples have stayed in this remarkably consistent narrow band of 9 to 12 times EBITDA for 15 years. This proves that private equity doesn't panic like the public markets.
Or it proves they're in denial because they haven't marked their assets to market yet.
No, I think that's too cynical. It proves the buy and hold advantages are evergreen. We have access to private information, walking the factory floors, talking to customers, that allows for prudent underwriting. And the rise in holding periods, with the median now at 3.3 years and a third of assets held over 5 years,
That's not a failure. That's the model working. Owners can wait. They are patient capital. They don't have to sell into a bad market. They can wait for the thaw.
I see why you think that stability implies health. But let me offer a different perspective. That patience you mentioned might just be a trap if the underlying engine is broken. Let's move to the drivers of return. The source material has a value creation bridge that I think proves my point about the death of financial engineering definitively.
The bridge is insightful. I agree. It breaks down exactly where the return comes from, mathematically.
Insightful? It's a smoking gun. The analysis looked at current underwriting. It found that 93% of value creation is expected to come from revenue and EBITDA growth. 93%. So almost all of your return has to come from making the business bigger and more profitable. But here's the kicker. Multiple expansion, that old trick of buying at 10 times EBITDA and selling at 12, is no longer a driver.
It's worse than not being a driver, isn't it?
Exactly. Underwriting now assumes a negative 14% drag from multiple compression.
Right. So you're literally betting the market will pay less for the asset when you sell it than when you bought it.
Precisely. So if you're a PE firm, you're starting the race with a 14% penalty. You're starting in a hole. And you cannot engineer your way out of that hole with debt because debt is expensive now. You have to operate your way out of it. You have to grow earnings so aggressively that you overcome that valuation drop. That is why I say the easy money is dead. And this is where the AI element becomes non-negotiable.
That's a compelling point and the math is undeniable, but I think you're looking at this a bit narrowly. I acknowledge the shift away from market-based levers, we agree there. But I would frame the solution differently. The number one skills-based lever in the report wasn't operations, it was investment selection.
Selection is the prerequisite, but it's not the engine. You can select the great car, but you still have to drive it.
It's the foundation. If you're starting with a drag, the answer isn't necessarily to become a tech incubator. The answer is to pick all-weather businesses. We're talking mission-critical products, low cyclicality, services that people need no matter what the macro environment is. If you pick the right asset, an asset-light, service-oriented business with secular growth, that 93% growth happens much more naturally. You don't need to radically reinvent the wheel. You need to buy a wheel that already rolls downhill.
But that ignores the threats to those all-weather businesses. You talk about selection, but what are you selecting against? The source material explicitly lists artificial intelligence as a key diligence factor right alongside recession concerns. In this new world, you can't just buy a good business and sit on it. The moat is being filled in.
It lists it as a factor, yes.
As a significant disruptor, the analysis highlights that wage pressure and labor availability are causing margin compression everywhere, even in good businesses. So how do you solve for that while trying to get that massive EBITDA growth? You have to deploy technology. You have to deploy AI.
So every PE firm needs to become a tech firm now? That seems like a stretch.
No, but every firm needs to be tech competent. Look, the report specifically mentions margin compression. If you have a business with 500 employees handling customer service and wages go up 5% a year, your EBITDA is shrinking. You have to deploy GenAI to automate those workflows. If a firm isn't actively using GenAI to write code, handle queries, or optimize supply chains, they are not going to hit their growth targets. Or worse, they're going to buy a mission-critical business that gets eaten alive by a new entrant using AI to do it cheaper and faster.
I come at it a different way. Of course, AI is a diligence item. You have to check if a business is vulnerable. But I challenge the idea that every PE firm has to morph into a deep tech operator. The source frames AI primarily as a risk to be managed, something to watch out for. It's about risk mitigation, not necessarily the primary value driver for every single deal.
But if you don't use it as a driver, you lose the margin. It's defensive and offensive.
Not necessarily. Remember who you're selling to. This is crucial. The analysis shows that 40 to 60% of exits are to strategic corporate acquirers. Think big public companies. What do they want? Do they want a speculative AI experiment where the PE firm fired half the staff and replaced them with a chatbot that might hallucinate? No.
They want growth.
The source says clearly, they want scale, profitability, and growth. They want stable, good businesses. that fit into their existing machinery. If you spend 5 years overhauling a company's entire operating model with bleeding-edge tech, you might actually make it harder to sell. Sometimes operational excellence just means running a tight ship and professionalizing the business, not revolutionizing it.
I think you're underestimating the speed of the shift. But let's pivot to the mechanism of that sale. You mentioned exits. We need to talk about the liquidity crisis, because this is where that patient capital argument gets really tested.
It is being tested, certainly, but testing makes it stronger.
It's barely passing the test. Distributions are at 10 to 15%. IPOs are a tiny fraction of exits. And with corporate M&A down, the industry is stuck. That circular problem. If firms can't exit, they can't raise, the machine is jammed. The hold period getting longer isn't just patience, it's an inability to leave the room.
I would frame that differently. The machine isn't jammed, it's adapting. This is the beauty of the private market. When the public IPO window shuts, the private market innovates. Look at the explosion of the secondary market.
You mean PE firms just buying and selling to each other?
It's more sophisticated. I'm talking specifically about GP-led secondaries, which now make up about half of that market. This is a crucial evolution. Let's say a firm has a great asset, but the fund life is ending and LPs want their money back. In the old days, they'd be forced to sell.
And now?
Now, they move that asset into a continuation vehicle. New investors come in to pay off the old LPs, but the general partner keeps controlling the asset. They get more time and more capital to grow it.
But isn't that just kicking the can down the road? Moving an asset from one pocket to another to manufacture liquidity?
No, it's maximizing value. It's active ownership. If you believe the asset has more room to run, maybe you need another 2 years to implement those AI strategies you love. Why sell it to a stranger? And it's not just secondaries. We're seeing midlife co-investments. Firms are bringing in partners to inject capital into existing companies. This proves the resilience of the model. They can hold good assets longer while still solving the liquidity puzzle. They are not forced sellers. That is the distinction.
I see the creativity. I do. It's clever structuring. But I worry about the capital structure underlying all of this. We have to talk about leverage. The debt. The source notes leverage multiples have stayed constant at around 5 times EBITDA. That sounds safe, right?
It's been consistent. It shows discipline.
Consistent leverage, sure. But the cost of that leverage has skyrocketed. In the zero interest rate era, 5 times leverage was cheap. Today, that interest expense is eating free cash flow alive. The source explicitly says higher for longer rates are a huge concern because it removes the ability to delever.
Explain that mechanism, just for our listeners.
Well, usually a P firm uses the company's own cash flow to pay down the debt, and that increases their equity value. Classic LBO model. But right now, you can't pay down the debt if all your cash is going just to cover the interest payments. So you're stuck. And again, I return to my thesis. The only way out is massive growth. You cannot rely on the balance sheet anymore.
I just don't buy that the debt is a death sentence. For growth-focused investments, which is where the industry has shifted, the interest expense is less concerning.
Why? Interest is interest. It has to be paid.
Because the growth outpaces the cost of debt. If you're buying a company that's growing its top line at 15 or 20%, the interest rate being 7% instead of 3% is manageable. It's a cost of doing business, not an existential crisis. And the capital structures are described as prudent. Equity contributions have actually increased.
So they're putting more skin in the game.
Exactly. And the banks are returning to the table. Credit is becoming available again. The thaw is happening in lending too.
If you hit the growth, that's the big if. If you put 20% growth and you only get 5% because an AI-driven competitor stole your market share, that prudent leverage suddenly becomes a noose.
Which is something we can agree on. The dispersion between managers is widening.
Exactly. Okay, so let's wrap this up. You look at this data and you see a system that is stress-tested but functioning. You see the longer hold periods, the creative secondary markets, and the stable valuations as evidence of adaptability. You believe that by selecting good businesses and being patient, the returns will come.
I do. While the market-based easy wins are gone, the private equity model is functioning exactly as designed. It's using private information to buy high-quality companies, holding them patiently, and selling them to strategic buyers. The thaw is already starting. The bid-ask spread is narrowing. We're seeing the machinery start to hum again. It's not a new machine, it just had to shift gears.
And I simply can't be that optimistic.
I believe the margin for error has vanished completely. When you have multiple compression dragging returns down by 14% out of the gate, the only path to a 20% IRR is through flawless execution. That means organic growth, and today organic growth means mastering technological disruption. The financial engineering phase is over. The operational excellence phase, powered by things like AI, is the only one left.
And I suspect the truth, as always, lies in the execution of those strategies. The best ideas emerge from rigorous challenge, and the market is certainly challenging these firms right now.
It certainly is. The divergence between high-quality and low-quality managers is going to be the story of the next decade. And we'd encourage our listeners to look deeper into how their investments are sourcing growth. Is it skill, or are they still just hoping for a market bailout?
Indeed. Dig into the diligence.
That does it for this edition of The Debate. Thank you for listening.